Coming up on the SBS on the Money podcast, we take a look at the property hotspots for the new financial year. The US dollar continues to weaken and investors sitting on the sidelines on the Australian share market. We'll have all the details next. Hi everyone, happy new financial year because it is Tuesday the 1st of July 2025. Not necessarily too happy on the share market because the ASX 200 flat, 8,541, but still plenty to talk about with Mark Gardner from MPC Markets in a few moments. But we'll start with the property market because interest rate cuts have propelled home prices higher last financial year across all capital cities except one. Cotality says the median national price rose to a record in the 12 months to June, and while it's a 3.4% increase, it's also the slowest annual result since August 2023. Of the capitals, Adelaide was the best performer over the financial year, with prices up 8%, that's the median price, followed by Brisbane, Perth and Darwin. Sydney remains the most expensive capital. A median property there, $1.2 million, and prices up 1.3 over the last 12 months, while Melbourne was the only one to record a fall, down 0.4%. Month on month, prices rose just 0.6% nationally. So I spoke with Cotality's head of research, Tim Lawless, to describe that pace of growth.
It's pretty mild, Ricardo. I mean, a 0.6% rise definitely isn't shooting the lights out, but the difference here is it's really broad-based. We're seeing values rising virtually everywhere, almost every capital city apart from Hobart, every regional market, and it's happening since the first rate cut back in February. So I think in summary, it's a very, I suppose, broad-based growth cycle we're moving into, but we're not seeing values rising all that quickly.
Also, it's happening, though, in your report, against a backdrop of relatively low home sales. Why, and what does that mean?
I think there's a couple of reasons for this. So we're seeing annualized turnover tracking at about 4.9% at the moment. That's a little bit below average. You typically expect to see a little bit more than 5% of homes transacting a year. Back in the height of the pandemic, when the market was really frothy, we were seeing about 6% turnover. So part of this is simply due to the fact that there's a lot of barriers to more people transacting. Particularly affordability is really stretched. Lending policies are pretty conservative. Household debt levels are relatively high. But there's also the fact that stock levels are really low. And I think that in itself keeps a bit of a lid on volume. Listing numbers are generally well below average across most markets now.
If we look at the national picture over the last financial year, prices are up 3.4% nationally. How does that compare and how would you rate it?
So that's, again, a pretty mild outcome. I mean, a 3.4% in dollar terms, that means we've seen the market go up about $27,000 on the median value. And there's a couple of markets, well, Melbourne in particular, where values were just down a little bit over the past 12 months. But to give you some context, 3.4%, that's the lowest annual growth rate we've seen since about August of 2023. And to go back again at the height of the pandemic, when the market was racing along, we were seeing about a 25% national annual growth rate. So 3.4%, it's sustainable, it's relatively low, but there's quite a bit of diversity there. Those mid-sized capitals still leading the annual pace of growth, even though they're slowing down. And some of those softer markets like Melbourne and Hobart sort of just around the neutral mark.
So looking ahead into the new financial year, what do you ultimately think will drive prices and just how strong do you think the market can be?
Well, ultimately, this is about interest rates. And I think it's no surprise that we saw this positive inflection in value trends in line with the February rate cut and then propelled along by the May rate cut. And chances are we'll see another rate cut next month, a few more later in the year. So that should support housing markets. But as I mentioned, there's still a few barriers in place that are probably going to be preventing this market moving into a more significant growth cycle. So my guess is with affordability quite constrained, lending policy pretty limited as well, we'll probably only see housing values rising somewhere between 5 and 10% nationally, probably on the more conservative side of that estimate.
As we know, there are many different markets around Australia. It's not just one housing market. So which parts of the country do you see as having the best growth in the new year? And what are your predictions for the property hotspots of FY26?
Hard question, mate. I'd probably be looking towards markets like Melbourne to outperform. I mean, Melbourne's been an underperformer over the last 5 years or so. So it's really built up this very strong competitive affordability advantage. We're starting to see interstate migration moving back towards positive territory. Yields are a bit higher, and starting to hear investors becoming a little bit more interested in the Melbourne market. I mean, as a bit of an outlier, Darwin is a very strong market now. It's finally just gotten back above its record highs from all the way back in 2014. It's a very affordable market, again, quite attractive to investors. Outside of those two, I'd also be looking towards Southeast Queensland. There's a huge amount of infrastructure underway that's got a hard deadline with the Olympics, a lot of population growth coming across the border, and a sheer undersupply of housing in that market as well.
And finally, we've spoken about, property markets for owner occupiers and investors, but what about the rental market? What's that like? I know that the Bureau of Stats, when they talk about inflation, they're starting to see those price increases moderate quite significantly now.
Yeah, absolutely. The private sector data tends to lead the CPI rental data, and we've been seeing rental markets slowing for a couple of years now. The annual rate of growth at about 3.4% for rental movements. We haven't seen it that low since early 2021. Rents aren't going backwards, and they're coming out of this period of extraordinary rental growth. So there's no real relief here for renters. But the good news is we're not seeing rents rising anywhere near as quickly anymore. And chances are, with vacancy rates still really tight, we'll continue to see some mild upwards pressure on rents. But it's hard to see rents rising materially higher, given most renters are dedicating about a third of their income to paying rent. And it's pretty hard for them to pay more than that, especially given this recent history of cost of living pressures.
That's Tim Lawless there from Cotality.
Now, Market Day on the SBS On The Money podcast.
First trading day of the new financial year, and the market finishes flat. The S&P ASX 200, 8,541. That's despite another record day on Wall Street overnight, where the S&P 500 and down the road, the Nasdaq also hitting record highs. To tell us more, I spoke with Mark Gardner, CEO at MPC Markets. So, Mark, US shares hit a record overnight. Here, the response has been a bit more muted. Why, and what's going on?
Overall, I think what we saw was the end of quarter move in the US, the banking sector over there doing relatively well after the Federal Reserve's given the all clear on the stress test for the banks on Friday. There is a tendency at the end of quarters for fund managers, etc., to prop up the market a little bit and lock in those gains for the quarter. I dare say that most market analysts or fund managers or investors certainly would not have expected the market to finish here, given where we went to in those April lows.
I think locally the market's been quite quiet, but I did find an interesting story in the US dollar, right? 6 months into 2025, the US dollar has had its worst half-year period since 1973, down almost 11% on the US dollar index. So that's like a basket of currencies. I think it's 6 currencies. So what's happening there?
Essentially, that US debt, if you think about it in terms of a credit rating, even just for an individual, if you rack up a large debt and then you've got a reduced ability to pay, obviously your credit rating goes down. That's happening to the US. It's been the reserve currency for a number of years now. It took a couple of hundred years for it to get through $1 trillion in debt, and then it's spiraled out of control since pretty much the GFC and the credit crisis in 2007 to 2011. So essentially what's happening is when the Federal Reserve prints money, that devalues the currency. The US, because of those mega cap companies and the investor inflows from foreign sovereign funds, etc., it's propped up the US dollar. But overall, staring down the barrel of Trump essentially not addressing the US debt, I think there'll be further credit downgrades down the line. So people are getting away from the US dollar. It's been a bit of a trend for probably the last year and a half. You can see it in the rise in gold prices, the rise of Bitcoin, particularly as a store of value because people are worried about central banks printing money again. So it very much is a lack of confidence in the US remaining the reserve currency of the world, which is why it's a little bit patchy between the Australian dollar. It's not necessarily to do with the Australian dollar or the euro or the yen. It's more to do with people losing a little bit of faith in where the US is headed.
Yeah, how does the Aussie sit against all those other currencies? Because, like you mentioned, if it's a story about the US dollar, investors losing confidence in the US dollar, because we see the Aussie at about 66, US, which it hasn't been at a while, but against the euro and pound, it hasn't made those kind of gains.
Yeah, I think, again, it comes back to a lack of confidence in the US dollar. The Aussie itself is probably a lot more tied to the Chinese currency and the Chinese economy because of our mining sector in particular. And I would say if we are considered what's called a risk currency, which I don't necessarily agree with, but I think that we will see the Aussie dollar start to head higher and people start to see an attraction, particularly in we have the largest mining sector to invest in the world, essentially. We'll see those inflows start to come in and the Aussie start to be propped up when we see a recovery in China, which there has been stimulus so far over the last sort of 12 or 6 to 12 months, 6 months particularly. But we haven't seen a massive effect as yet. But as that starts to get traction and the trade wars, etc., start to get sorted out, I would expect the Aussie dollar to head higher and piggyback that Chinese recovery with our mining sector.
Okay, so we're at the start of a new financial year. Can we now focus on the equities market? How are you feeling as an investor going into the next 12 months? And what do you see as the key market moving events of financial year 26?
Well, I think as an investor, you'd be overjoyed with the market here. It's an absolute result considering where we were. It's the fastest bounce out of a technical bear market, which is down, technically it's down 20%, triggers a bear market. I don't think we've ever seen a recovery we've never seen a recovery this fast, certainly nowhere near in this period of time. So as an investor, I'd be very, very happy. As a realist, I've got to say there is a lot going on. And I think Trump's ability to have an endless flow of white noise news stories from Iran-Israel conflict to the big, beautiful bill, everything gets a name. He plays the media and the media cycle very well. But I think that all of these issues, like there are no trade deals done as yet. That deadline comes up in, I think, 8 days on July the 9th. Effectively, we've only had 2 or 3 trade deals done, despite there being talk from the US government about there being a deal done with China. China's been very quiet on it, so I'm not entirely sure how solid that trade deal really is, or whether that's just PR from the US government. But we've effectively had the big signing of a deal with the UK. But since Brexit, the UK has been desperate to sign a trade deal with anyone. So I really think that they've got a significant job ahead of them. And I think what Trump and the Trump administration is trying to do at the moment is just get this big, beautiful bill through, which he's finding resistance for because it actually worsens the debt. But once he gets that through, I think you'll start to see the arbitrary threats start to surface again, like we saw with Canada, a couple of days ago when they tried to take on those digital taxes, where essentially those Mag 7 companies that essentially do business all over the world funnel their profits back to tax havens and don't effectively contribute to the places where they're dealing. So, that I think Australia was at the forefront of trying to pioneer that policy. You deal here, you pay here. But I think we're in for a very large week next week as Trump starts to heat up that those trade deal negotiations again.
So with all of that in mind, what are you telling your clients right now, and where do you see the opportunities for investors?
I'm telling my clients to be cautiously optimistic. At this point in time, I think there are still sectors of the market that are still going to do very well. There are some very clear policy changes from Trump, and there's some very clear policy changes in sectors like the energy sector, where we've seen the likes of 10 or 20 deals done by Microsoft, Apple, Amazon, Meta, etc. And even the state of New York is building its first nuclear power plant in over 20 years. So I think the thematic of AI and the data centers that need to power that AI capacity is it's a national security issue for governments globally, because the race to be first and at the cutting edge of that is going to be a high priority from a national security point of view, as we saw with the chip wars back in the 80s and 90s. And things like defense as well. Trump's ability Trump's desire for there to be a user pay system and get Europe to start funding NATO more, etc., will start to benefit defence and military spending, because I think the latest estimates are for a 1% increase of global GDP in spending on military over the coming 2 or 3 years, and that is a significant amount of money that's going to be obviously governments that will want to spend in their own backyard. So instead of the US just being the defender of the world, you've got the likes of BAE Systems in the UK, Thales in France, Leonardo in Italy. You've got the likes of DroneShield and Austal here, all seeing that increased military spending being funneled. So I think those two thematics will do very well, and the AI thematic will continue to do well. However, the rest of the broader market, I think, is probably in for a little bit of a shock as we come into what is seasonally the worst quarter for equity markets in the year.
That's Mark Gardner there from MPC Markets. Don't forget to give this podcast a rating or a review on Apple Podcasts and Spotify is what I'm trying to say. Also, give it a subscribe if you want to be alerted whenever the podcast comes out.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.